I agree that we're looking at, people are looking for organic growth. They're looking for a dynamic growth. They're looking for a place to hide. And right now that feels safe in the names that have done well. I think as we start to approach the 3,000 mark again, we've tried to get there a couple of times. And I think if you look at what's happening, I mean, we need a lot of tailwinds to keep this thing going. We need the Fed to act, but economic data to get a little bit better. We need the USD to stay where it is. And we also need, improvement in China and Europe. And I think that as you start to get closer to that 3,000 mark, I don't know how safe a hideout it's going to feel because we've been here before and we haven't been able to do it. And I don't think the environment's as supportive as it has been the last couple of times we tried to get there.
Why do we need the Fed? Why do we need the Fed to act? Because the market is baking it in, or because there's a genuine use for another 25 basis points added onto the pile with $13 trillion worth of sovereign securities currently yielding a negative number? What's the reason?
Because of the market.
Financial conditions have never been easier, so it's pure market psychology.
Absolutely,
right?
I agree.
Part of that is technical, too. Do you really want an inverted yield curve that has technical factors, and then you get all the algos selling off, too? So I agree with you. I mean, we don't need it.
So that's a chick. All right, so let me ask you your opinion on this then. That's chicken or egg. Does the yield curve invert because the economy dictates it, or does the economy roll over because the yield curve inverted? I don't believe the latter.
The latter, I don't believe.
Okay.
I don't think we can get past 3,000 unless the yield curve starts to steepen. So, I mean, I think that's another one of those requirements.
The only reason I'm staying long, by the way, is for G20. I'm not staying long because I think equities are undervalued at 17, 18 times next year's number. They're not, with growth continuing to slow. We have revisions that came out. Facts that put it out. We're going to have negative earnings now with the revisions. So I'm playing purely for that one event. I don't believe that if we get a deal with China, and we're not going to get a deal at G20, that's really going to do anything to drive the global economy. So I'd rather be in cash after that event. That's a dangerous play, and I may ultimately go more into ETFs and single stocks, because the impact will be much greater single stocks.
We've been asking since January, can the market rally without a deal with China? Well, we're up 18% year to date. So the answer is that is still a sideshow, unfortunately. And maybe they meet face to face, and on Friday they say something like, "Okay, we're going to leave the $250 billion worth of goods that have tariffs on it, but we won't add the next $300 billion because we're negotiating."
Yes.
Maybe that's the outcome.
Let me ask you why the market has rallied in lieu of a deal with China.
Because the effects have not. The Fed, of course. The effects have not derailed earnings growth for the S&P 500 yet. Still to be determined. Hasn't
and the market believes that the Fed is going to. There's still that Fed put. And that may be the biggest phenomenon since the beginning of the year, since the December low. And